I'm watching the news from Washington this morning, and it reminds me of something I learned a long time ago in Omaha. When everyone's shouting about the theater being on fire, sometimes you need to stop and ask yourself, is there actually smoke, or are we all just watching the same dramatic performance? 3 minutes ago, headlines started flashing across every screen. Trump hit with new impeachment push in Congress. The markets barely blinked, and that right there, that tells you something important about what's really happening in this country right now. Let me tell you what concerns me, not the political theater, not the headlines. What concerns me is that while everyone's watching this show in Washington, they're missing the real story. And the real story is about something far more fundamental than any single politician or any single political party. See, I've been investing for over 7 decades now. I've watched markets through 13 presidents. Republicans, Democrats, doesn't matter. I've seen impeachment proceedings, scandals, resignations, landslide victories, and razor-thin margins. And here's what I've learned that nobody seems to remember anymore. The stock market doesn't care about your political team. It cares about earnings, cash flow, return on capital, the fundamental ability of businesses to create value over time. That's it. Everything else is noise. But right now, in late 2025, we're living through something different. We're living through a moment where that noise has gotten so loud that people have started to confuse it with the signal. They think the political drama ice the investment thesis. And that's when people get hurt. Let me tell you what I'm seeing out there. I'm seeing portfolios built not on analysis of business fundamentals, but on political predictions. I'm seeing people making investment decisions based on who they think will win the next election, what policies might get passed, which party controls which chamber of Congress. Now, before I explain why this concerns me so deeply, let me show you what the bulls are seeing, because they've got a story to tell, and it's worth understanding. The optimists look at Washington right now, and they see clarity coming. They see an impeachment push that probably won't succeed. They see a second Trump administration with policy directions that are becoming clear. They see potential tax policy, regulatory changes, trade negotiations. And they're building their investment strategies around predicting how all of this plays out. Some of the smartest people on Wall Street are making very specific bets right now. They're buying defense stocks because they expect increased military spending. They're buying energy stocks because they expect certain regulatory rollbacks. They're buying financial stocks because they expect changes to banking oversight. They're shorting renewable energy because they expect policy shifts. And look, I understand the logic. These are not stupid people. These are sophisticated investors with access to better information than most of us will ever have. They're talking to people inside the administration. They're reading policy memos before they become public. They're modeling out scenarios with precision that would have been impossible 20 years ago. The argument goes like this. Politics drives policy. Policy drives regulation. Regulation drives profitability. Therefore, if you can predict the politics, you can predict the profits. It's a clean, logical chain of reasoning. And there's historical precedent for this working. Some of the biggest fortunes in American history were made by people who correctly anticipated political changes and positioned themselves ahead of time. The robber barons of the late 19th century didn't just build railroads. They built railroads where they knew the government would grant them land in favorable terms. More recently, investors who correctly predicted the impact of the Affordable Care Act made fortunes in healthcare stocks. People who anticipated the financial crisis regulations made money, betting on which banks would survive and which wouldn't. Those who saw the 2017 tax cuts coming positioned themselves in companies that would benefit most. So when these investors look at Washington today, they see opportunity. They see a government making clear policy choices. They see an administration with a track record, so there's less uncertainty about direction. They see congressional dynamics that, for all the drama, are actually becoming more predictable in terms of what can and cannot pass. The bulls will tell you that markets hate uncertainty more than they hate bad news. And right now, even with an impeachment push, even with all the political noise, there's actually less policy uncertainty than there was a year ago. We know roughly what trade policy looks like. We know roughly what tax policy looks like. We know roughly what regulatory approach to expect. Plus, and this is important, the bulls argue that all this political drama is actually a positive for markets because it distracts the government from doing anything that might disrupt the economy. Gridlock, they say, is good for business. When politicians are fighting each other, they're not passing new regulations. They're not raising taxes. They're leaving businesses alone to operate. There's even an academic argument for this. Studies have shown that markets often perform better during periods of divided government than during periods where one party controls everything. The theory is that divided government means less dramatic policy changes, which means more stability for business planning. And if you look at the numbers right now, the bulls have ammunition. Corporate earnings are strong. Unemployment is low. GDP growth is positive. The S&P 500 is near all-time highs. Consumer spending remains robust. None of the traditional recession indicators are flashing red. So when they see a headline about impeachment, they shrug. They've seen this movie before. Clinton got impeached, and the market barely noticed. Trump got impeached twice in his first term, and the market kept climbing. Nixon faced impeachment, and the market's problems had nothing to do with Watergate, everything to do with oil shocks and inflation. The sophisticated investors will tell you that political drama is the ultimate distraction from what really matters. And what really matters is that American businesses continue to generate profits, American consumers continue to spend money, and American innovation continues to drive global growth. They look at companies like Apple, Microsoft, Google, Amazon, and they say, these companies will be fine regardless of who's in the White House. Their earnings come from global operations, from technological advantages, from network effects and scale economies that no politician can touch. Some will even argue that political instability is good for certain investments. Gold bugs love political chaos. Defense contractors don't mind tension and uncertainty. Media companies make more money when politics is dramatic and people are glued to their screens. Now, all of that sounds good, doesn't it? It sounds reasonable. It sounds like the kind of sophisticated thinking that separates the professionals from the amateurs. You can imagine yourself at a cocktail party explaining to someone why you're not worried about the impeachment news because you understand the deeper dynamics at play. But here's the problem. Stop me if you've heard this one before. Smart people with good information making logical arguments about why political analysis should drive investment decisions. And then reality comes along and reminds everyone that the market doesn't care about your thesis, no matter how clever it is. I've been doing this a long time, longer than most people in the market today have been alive. And I can tell you with absolute certainty that every single time I've seen investors get excited about making money from political predictions, most of them have ended up disappointed, not because they were wrong about the politics. Sometimes they were right about the politics, but they were wrong about what it meant for their investments. Let me ask you something. If I told you in 2016 that Trump would win the presidency, that he'd face multiple impeachment proceedings, that there would be a global pandemic, that there would be the worst civil unrest in decades, that he'd lose re-election, then win again 4 years later, if I told you all of that chaos was coming, what would you have predicted for the stock market? Most people would have said it would crash. How could it not? That's an unprecedented level of political and social turmoil. But here's what actually happened. The market went up a lot because the market doesn't run on political predictions. It runs on earnings and cash flow and the Fed's interest rate policy and 1,000 other variables that have nothing to do with who's getting impeached this week. Now here's what concerns me, and I mean really concerns me deep in my gut. The way I get concerned when I see people making the same mistakes over and over again. People are building their entire investment strategy around predicting political outcomes, not as one factor among many, as THE factor, the primary driver of their decisions. And worse, they're doing it with borrowed money. Margin debt is elevated. Options trading is through the roof. People aren't just betting on their political predictions. They're leveraging those bets, multiplying their potential losses. I learned something a long time ago from Ben Graham. He taught me that investing is most intelligent when it is most businesslike. What does that mean? It means you should invest in a company the same way you would think about buying the entire company outright. So let me ask you, if you were going to buy a business, let's say a furniture store in Omaha, would you base your decision primarily on who the president is? Would you pay a different price for that furniture store depending on whether there's an impeachment proceeding happening in Washington? Of course not. You'd look at the fundamentals. Does the store have good products, good management, good location, loyal customers, reasonable debt levels, the ability to generate free cash flow year after year regardless of political winds? But that's not what people are doing in the market today. They're paying wildly different prices for the same businesses based entirely on political scenarios. And that's not investing, that's speculation. It's gambling on outcomes that even the smartest people cannot reliably predict. Let me tell you what I'm doing. I'm selling stocks where the valuation seems based on a specific political outcome. I'm avoiding sectors where the entire investment thesis depends on policy predictions. I'm staying away from companies that need government favor to succeed. Instead, I'm looking for businesses that will be fine no matter who's in Washington. Companies with products people need regardless of politics. Strong balance sheets, proven management teams, competitive advantages that don't depend on regulatory protection or government subsidies. Now, if this sounds familiar, it's because I've seen versions of this movie before. Let me take you back to a very specific moment in American history that I remember clearly. It was 1973. I was already running Berkshire Hathaway, but I wasn't yet the household name I'd become later. Richard Nixon was president, and he was facing increasing pressure over something called Watergate. Most people didn't know what it meant yet, but those of us who were paying attention could see a constitutional crisis building. The market was already having a tough time. We'd ended the gold standard in 1971. Inflation was starting to pick up, but Watergate added a new layer of uncertainty. Every week brought new revelations. The Saturday Night Massacre, when Nixon fired the special prosecutor, the missing minutes on the tapes. The slow, grinding progression toward what everyone knew was coming, impeachment or resignation. And investors were terrified, not just of Nixon, but of what it all meant. Would the presidency survive? Would American democracy hold together? Would there be a constitutional crisis that paralyzed the government? I remember sitting in my office in Omaha, reading the newspapers, watching the evening news. And I remember the conversations I was having with other investors. Smart people, serious people, and they were all trying to game out the political scenarios. If Nixon resigns, who becomes president? If Ford becomes president, what does that mean for policy? Should we sell everything and wait for clarity? And you know what happened? The absolute best investments I made during that period had nothing to do with predicting the Watergate outcome. They had everything to do with finding great businesses trading at bargain prices, because everyone else was distracted by politics. I bought the Washington Post in 1973, right in the middle of Watergate, not because I had any special insight into how the political crisis would resolve, but because it was a great business run by a great person, Katharine Graham, and it was trading at a fraction of its intrinsic value. The market gave me that price because everyone else was paralyzed by political uncertainty. See, here's what I learned. Political crises come and go. They always feel unprecedented at the time. People always think, this time is different. This time the republic might actually fall apart. And you know what? The republic never falls apart. It bends, it flexes, it survives. And on the other side of the crisis, the same fundamentals that mattered before the crisis still matter. Let me tell you about another moment, January 1998. Bill Clinton was president, and he was about to face impeachment over his relationship with Monica Lewinsky. The scandal had been building for months. Every day brought new revelations, new legal arguments, new constitutional debates. And once again, investors were trying to game it out. Will he be impeached? Will he be convicted? Will he resign? What happens to the economy if we're in the middle of impeachment proceedings? Should we sell stocks and wait for resolution? I remember the conversations I had during that period. People calling me, asking what I thought, not about businesses, about politics. As if I had some crystal ball that could predict how the Senate would vote. And you know what happened? The market went up during the entire impeachment process, went up significantly. Because while everyone was watching the drama in Washington, American businesses were doing what they do, creating products, serving customers, generating earnings. The fundamentals didn't care about the impeachment. Then there was Trump's first term, impeached in December 2019 over Ukraine. Everyone thought surely this would hurt the markets. All that uncertainty, all that political chaos, and the market kept climbing. Then he was impeached again in January 2021 after the Capitol riot. Markets barely blinked. You see the pattern. Over and over, investors think political drama is Teach-E story. And over, it turns out to be a story, but not Teach story. Not the thing that actually drives long-term investment returns. But here's where it gets interesting, and this is important, so pay attention. Sometimes political events DO matter for markets, but not in the way people expect. Not in the direct, obvious way where you can draw a straight line from political outcome to investment return. The political events that matter are the ones that change fundamental economic conditions, not the theatrical ones, not the scandals and the investigations and the impeachments. Those are noise. What matters is when politics changes the money supply, when it changes tax rates on corporate earnings, when it changes the regulatory environment in ways that genuinely affect business profitability, when it changes trade relationships that alter supply chains and cost structures. But here's the thing about those changes. They usually happen slowly, through boring policy processes not dramatic political events. The real consequential stuff happens in committee meetings, in regulatory rule-making processes and Federal Reserve decisions that most people never hear about. The drama, the headlines, the stuff everyone's talking about, that's usually not where the real changes happen. That's the distraction. So when I see headlines about a new impeachment push, my first question isn't, what will this mean for the market? My first question is, what is this distracting me from? What are the actual policy changes happening while everyone's watching the show? And right now, let me tell you what I'm watching. Not the impeachment, not the political theater. I'm watching the fundamentals that actually matter. I'm watching corporate profit margins, which have been elevated for years and might be due for mean reversion. I'm watching the Federal Reserve's balance sheet and interest rate policy, which have far more impact on asset prices than any impeachment. I'm watching the massive government debt levels, which will eventually require either higher taxes, reduced spending, or inflation to resolve. I'm watching the concentration of market gains in a handful of technology stocks, which has created a market structure that's more fragile than the index levels suggest. I'm watching private equity valuations that seem disconnected from underlying business fundamentals. I'm watching commercial real estate, which faces structural challenges that have nothing to do with politics. These are the things that will determine whether your investments make money over the next decade, not who gets impeached, not which party controls Congress, not the daily drama from Washington. But nobody wants to hear that. You know why? Because it's boring, it's hard. It requires actually analyzing businesses, understanding competitive dynamics, thinking about long-term value creation. It's much easier to watch the political news and convince yourself that if you can just predict the political outcome, you'll get rich. That's the seductive thing about political investing. It feels like there's an answer, like you can crack the code. Like if you're just smart enough, plugged in enough, informed enough about what's happening in Washington, you can get an edge. But I've got news for you. Even the people inside Washington don't know what's going to happen next. You think members of Congress knew 3 minutes ago that there would be a new impeachment push. Some of them probably learned about it from the same headlines you did. This is the nature of politics. It's unpredictable, it's chaotic, it's driven by personalities and egos and events that nobody can foresee. Building an investment strategy around predicting political outcomes is like building a house on sand. Maybe you get lucky and the tide doesn't come in, but eventually it always does. Let me give you a framework for thinking about this. When you're evaluating an investment, ask yourself this question. If the government completely ignored this company for the next 20 years, neither helping nor hurting it, would it still be a good business? If the answer is yes, you might have a real investment. The company has genuine competitive advantages, loyal customers, products people need, management that knows how to allocate capital effectively. Politics might help it or hurt it around the margins, but the core business works regardless. If the answer is no, if the company needs specific policy outcomes to succeed, you don't have an investment, you have a political bet. And political bets are not investing, they're speculation. Now let me give you some numbers, because this is where it gets really concerning. The market data from recent months shows something troubling. Stock price movements have become increasingly correlated with political news flow rather than company-specific fundamentals. When there's political uncertainty, volatility spikes. When there's political clarity, volatility drops. But the actual earnings of the underlying companies aren't changing day to day based on political headlines. What this tells you is that prices have become disconnected from value. The market is pricing in political scenarios, not business fundamentals. And whenever you see the disconnect, whenever you see prices driven by narrative rather than numbers, that's when you need to be careful. Recent analysis of sector performance shows massive swings based on political predictions. Energy stocks up huge one day on regulatory hopes, down huge the next day when those hopes fade. Financial stocks whipsawing on speculation about oversight changes. Defense stocks moving on geopolitical rhetoric rather than actual contract wins. This is not normal. This is not how healthy markets operate. In a healthy market, stock prices move based on changes in expected future cash flows, new product launches, market share gains or losses, competitive threats, operating efficiency improvements, that sort of thing. But right now, stock prices are moving based on political predictions. And the problem with that is simple: political predictions are usually wrong. Look at the data on political prediction markets. These are platforms where people bet real money on political outcomes. You'd think they'd be pretty accurate, right? Money on the line, wisdom of crowds, all that. But the research shows they're not that good. They're better than random guessing, sure. but they regularly miss major outcomes. They missed Brexit. They missed Trump in 2016. They missed the scale of the 2020 turnout. They've missed numerous congressional outcomes, state elections, policy decisions. And if markets specifically designed to predict political outcomes can't do it reliably, what makes you think you can predict political outcomes well enough to base your investment strategy on those predictions? Here's another number that concerns me. The correlation between trading volume and political news has increased dramatically over the past several years, meaning more and more market activity is happening in response to political events rather than business developments. When a company reports earnings, you'd expect heavy trading volume as investors digest the news and adjust their positions. That makes sense. But increasingly, we're seeing the heaviest trading volumes not on earnings days, but on days when political news breaks. That's speculation, not investment. And it's not just retail investors doing this, it's institutions too. Hedge funds with sophisticated political analysis teams, private equity firms modeling different political scenarios, pension funds trying to position ahead of policy changes. The whole market has become increasingly politicized. And whenever I see the whole market moving in the same direction at the same time, for the same reason, I get nervous. That's usually when the biggest mistakes get made. Let me tell you what happens when everyone's making the same political bet. Eventually, that bet gets priced in. The stocks that would benefit from that political outcome get bid up. The stocks that would suffer get sold down. And then when the political outcome actually happens or doesn't happen, there's no more room for prices to move. This is the classic buy the rumor, sell the news dynamic. Except with political investing, it's even worse. Because at least with company news, there's usually some objective truth you can anchor to. Either the earnings were good or they weren't. Either the product launched or it didn't. But with political outcomes, there's infinite room for interpretation. An impeachment push might succeed or fail. But what does success even mean? Is it just the House vote? Is it conviction in the Senate? Is it the political fallout? The policy implications? Everyone can have a different definition, which means everyone can claim they were right regardless of what happens. This brings me to something Charlie Munger used to tell me all the time. He'd say, Warren, the most dangerous thing in investing is when you can't admit you were wrong, because you can always reinterpret the evidence to fit your narrative. And that's exactly what happens with political investing. The narrative is so flexible that you never have to admit your thesis was wrong. If the political outcome you predicted happens, but your stock goes down, you just say, the market hasn't recognized the implications yet. If the political outcome doesn't happen, but your stock goes up, you say, the market is looking past the near-term political noise. You can always explain away any result, which means you never learn. You never improve. You just keep making the same mistakes over and over. Now let me show you exactly how this ends, because I've seen this pattern enough times to know the common failure modes. Scenario one, you're right about the politics, but wrong about the market implications. This happens all the time. You correctly predict that certain legislation will pass, but it turns out the market had already priced that in, or the actual impact on business profits is different than you expected, or 100 other variables you didn't account for change the outcome. I've seen investors lose fortunes being right about politics, but wrong about what it meant for their investments. They predicted the Trump tax cuts in 2017, bought stocks accordingly, and then couldn't understand why those stocks didn't perform as expected, even though they got the politics exactly right. Scenario two, you're wrong about the politics. This one's obvious, but it happens more often than people expect. Even the smartest political analysts get big calls wrong. And when they're wrong, the investors who base their positions on those predictions get hurt. I've watched investors load up on healthcare stocks expecting certain policy outcomes that never materialized. I've seen people short entire sectors based on political predictions that turn out to be completely wrong. The losses can be severe. Scenario three, and this is the sneaky one, you're right about the politics, right about the market implications, but wrong about the timing. Even if you nail both the political outcome and its market impact, if you're early, you can still lose money. The market can stay irrational longer than you can stay solvent, as Keynes said. I've seen this destroy sophisticated investors. They had the right thesis. They would have been proven correct eventually. But they ran out of money or patience before they were vindicated, so they had to sell at a loss. Scenario four, the political outcome you're betting on happens. The market implications are what you expected. Your timing is good, but then something completely unrelated happens that swamps your political trade. A pandemic, a financial crisis, a technological disruption, a geopolitical event. This is the scenario people forget about. They get so focused on the political chess game that they forget the board itself could get flipped over by events that have nothing to do with domestic politics. Most likely scenario, all of the above happens to different parts of your portfolio at different times, and you end up with a complicated mess of winners and losers that would have been much simpler if you just focused on business fundamentals in the first place. Because here's the thing about investing based on politics. Even when it works, it doesn't scale. You can't build a repeatable, long-term, successful investment strategy around predicting political outcomes. It's too random, too chaotic, too dependent on specific moments and personalities. But you can build a repeatable, long-term, successful investment strategy around finding great businesses at reasonable prices and holding them through political cycles. That's a formula that works in any political environment. So what should you do? Let me tell you. First, honest self-assessment. Look at your portfolio right now. For each position, ask yourself, why do I own this? Is it because I believe in the long-term business fundamentals? Or is it because I'm betting on a political outcome? If you can't explain why you own something without reference to political scenarios, you probably shouldn't own it. Or at least, you should own a lot less of it. Second, stress test your assumptions. For each political bet you've made, ask, what if I'm wrong? What if the opposite happens? How much money will I lose? Can I afford that loss? If the answer makes you uncomfortable, reduce your position. Right now, don't wait for clarity. Clarity only comes after the opportunity to act as past. Third, refocus on fundamentals. What are the best businesses you can identify that will compound value over the next 20 years regardless of politics? Those are the companies you want to own. Everything else is noise. I'm looking at businesses with strong balance sheets because when political uncertainty causes market dislocations, those are the companies that can take advantage of opportunities. I'm looking at companies with pricing power because if we get inflation, those are the ones that can protect their margins. I'm looking at companies with loyal customers because that's a moat no politician can destroy. Fourth, increase your margin of safety. In normal times, I might be comfortable buying a great business at fair value. But in times of elevated political uncertainty, I want to buy at significant discounts. I want extra protection in case my analysis is wrong or events unfold in unexpected ways. This is basic risk management. When uncertainty is high, you should demand higher compensation for taking risk. That means lower prices, higher expected returns, bigger margin of safety. Fifth, reduce leverage. If you're investing on margin, if you're using options to amplify your bets, if you've borrowed money to invest, stop. Right now, political uncertainty plus financial leverage is a recipe for disaster. I've seen too many smart people get wiped out because they were over-leveraged when political events moved markets in unexpected ways. Don't be that person. You can't compound wealth if you get wiped out along the way. Sixth, lengthen your time horizon. If you're worried about political events over the next 6 months, you're trading, not investing. Real investing requires thinking in years and decades, not days and weeks. When I buy a stock, I'm buying a piece of a business that I'm prepared to hold forever if the fundamentals remain strong. Political cycles come and go. Great businesses endure. And here's something else that's worth thinking about. The best opportunities often come precisely when political uncertainty is highest. When everyone else is paralyzed by fear of the unknown, when capital is frozen because nobody wants to make a move until there's clarity, that's when you can find incredible businesses trading at incredible prices. I think about some of my best investments over the years. Many of them happened during moments of maximum political uncertainty, not because I predicted the political outcome correctly, but because the uncertainty itself created the opportunity. Other investors demanded too much of a discount for political risk, which meant I could buy wonderful businesses at wonderful prices. The key is having the courage to act when others won't. But that courage can't come from political predictions. It has to come from confidence in your fundamental analysis. You have to know the business well enough that you're comfortable owning it regardless of political outcomes. That's the difference between investment courage and foolish bravery. Investment courage comes from deep knowledge and conservative assumptions. Foolish bravery comes from conviction in your political predictions. Now let me tell you what I'm doing personally. I'm selling positions where the valuation seems predicated on specific political outcomes. I'm raising cash, which gives me flexibility if political uncertainty creates opportunities. I'm focusing on businesses with sustainable competitive advantages that don't depend on government favor. I'm not trying to predict whether this impeachment push will succeed or fail. I'm not gaming out scenarios for the next election. I'm not building elaborate models of different political futures. I'm doing what I've always done, looking for wonderful businesses at fair prices, buying when others are fearful and selling when others are greedy, focusing on the long term, avoiding debt and leverage, maintaining discipline. These principles work regardless of who's in the White House, which party controls Congress, or what political drama is dominating the headlines. They worked in the 1950s and 1960s. They worked through Watergate and the Cold War. They worked through 9/11 and the financial crisis. They'll work now. The market will do what it does. Politics will do what it does. Your job as an investor is not to predict the unpredictable. Your job is to buy good businesses at reasonable prices and let the power of compounding work in your favor. Rule number 1, don't lose money. Rule number 2, don't forget rule number 1. These rules apply whether there's an impeachment happening or not. They apply regardless of political circumstances. And here's the final thing I'll tell you. This impeachment push. 3 minutes ago, it was breaking news. Tomorrow, it'll be yesterday's news. Next week, it'll be forgotten in favor of some new political drama. But the businesses you own, the capital they deploy, the products they create, the customers they serve, those fundamentals will still matter. 20 years from now, nobody will remember this particular impeachment push. It'll be a footnote in history books if it's mentioned at all. But the investment decisions you make based on it, those could still be affecting your portfolio. So don't let the political theater distract you from the real work of investing. Don't let the noise drown out the signal. And for goodness sake, don't bet your financial future on your ability to predict political outcomes that even the politicians themselves can't predict. Stay focused on what matters. Business quality, valuation, competitive advantage, management integrity, financial strength, time horizon, margin of safety. These are the things that will determine whether you build wealth over time, not whether you correctly guessed what happens with this week's political drama. The markets will be here long after this impeachment push is forgotten. Make sure your portfolio is built to last just as long.